Good morning, good afternoon, or good evening to all of you. My name is Dietrich Domanski, and I'm the Secretary General of the Financial Stability Board. I'll be moderating this virtual workshop today on the evaluation of too big to fail reforms. Thanks to all of you for joining us today. This is the first time that the FSB has organized and advertised a workshop publicly, and there seems to be quite a bit of interest in the topic. We have more than 300 people registered and now almost 200 connected. One of the few advantages of the current situation is actually the ability to have a larger audience and therefore to be able to hear directly from a broad range of our stakeholders. So this is an experiment, and I should also note that we are recording this event. The FSB published a consultation document on the too big to fail evaluation on the 28th of June. We will hear more about that report in a couple of minutes. When the working group prepares the final report, it will take into account both the feedback received today and the written responses to the consultation. I very much encourage you to respond to the consultation in writing. The consultation is open until end September. Our purpose today is not to spend too much time describing the work that we have done. First and foremost today, we would like to hear from you. So we will only briefly remind you of what is in the report after my introduction, and then have as much as possible time for discussion. We have 3 topics on the agenda which correspond with the main chapters of the evaluation report. The first is the credibility of too big to fail reforms, and we will hear from Sir Paul Tucker, who is among other things a fellow at Harvard Kennedy School and the chair of the Systemic Risk Council, and from Alberto Gallo, who is head of macro strategies at Algebris on this topic. We will then discuss in the second round how banks reacted to the too big to fail reforms. Professor Vera Lachaya of New York University's Stern School of Business and Tomo Ishikawa, who is head of global regulatory affairs at Mitsubishi UFJ, will lead us off. Finally, we will discuss the broader effects of the reforms, and we will hear from Maria Sole Perea, Assistant Director at the IMF, and from Thierry Philipponin, Head of Research and Advocacy at Finance Watch. In each session, the speakers will give some brief introductory remarks on the topic, and I will then open the floor for discussion. You can put your hand up for comment by clicking on the hand button on the right-hand side of your screen. I will then invite individuals who have raised their hands to speak. Once you have spoken, please click on that button again, because there is no automatic function to do so and take the virtual hand down. We hope that lots of people will want to speak, and I will try to give everyone the opportunity to do so. We would like to get a range of perspectives on the consultation report. However, if it turns out that not everybody who wants to speak has the opportunity to in the time that we have available, please bear with us. You could follow up by email, and then your written comment will be considered. You may also ask a question in writing rather than speak. If you want to do that, you can use the chat function in WebEx, and you should be able to see a user named AAA Questions for Discussion at the top of the list of participants. Please send this user a private message with your question using the chat function. Given the ground we have to cover in the next couple of hours, I would encourage everybody to be concise. We have asked our lead of speakers to speak for no more than 5 minutes, and I would ask participants to speak for no more than 2 minutes. Also, if participants wish to make specific technical points, for example, on methodologies used, I would encourage them to submit these points by email in writing, and then we can follow up in specificity. I would also ask everyone to put their device on mute when they are not speaking. So without further ado, let me give the floor to Claudia Buch, who as well being as vice chair of the Deutsche Bundesbank is also chair of the working group that is carrying out the evaluation. Claudia, over to you.
Thank you very much, Dietrich. Thanks a lot to everybody who is participating also on behalf, and welcome also on behalf of the entire working group. Let me just cross-check that you can hear me well. Is it working?
Yes, we can.
Okay, perfect. I have a short presentation, which now here's some feedback. So there's a short presentation. Yes, I tried to also stick to the, maybe somebody has to mute the microphone. Yeah, I don't know whether. So let me start, and then you can all check whether your microphones are muted. So I would also like to stick to the 5-minute limit with my presentation, which is walking you through a long report with a lot of technical appendices, just to give you the main messages. So just to talk about what is it about, what is this evaluation about? Going to the next slide, please. Dominic, could we move to the next slide? Yes, thank you. I don't think I have to remind this audience what the too big to fail problem is about. So basically, this slide is to say, what are the reforms we are looking into that have the objective of reducing the cost and probability of financial crisis? So it's first and foremost the reforms that make banks more resilient, systemically important banks by through higher equity requirements, capital requirements. It's enhanced supervision, and it's comprehensive resolution regimes, improving resolvability. So basically, the too big to fail reforms that we're looking at in this report that we are evaluating address the systemic and moral hazard associated with systemically important banks. Now, if we go to the next slide, this tells you a bit how do we try to assess whether risks have actually fallen, because we can't observe either systemic risk and moral hazard. So what we do is we look first of all at the choices of banks affecting systemic risk, and we want to see whether there's any changes there. Then we are looking at the feasibility of resolution. So what choices do governments have now as compared to the situation before the reforms with regard to resolution and bailout? So that's the feasibility of resolution. And that, of course, has implications for the market perceptions of implicit funding subsidies, i.e. the credibility of the new resolution regimes. And then we, given this feedback between banks, governments, markets, we also want to see what are the broader effects on the economy and on markets. Going to the next slide shows you what's in the focus of our evaluation in terms of the banks we're looking at. And what's important here is that it's not just the globally systemically important banks, but also the DSIBs, so the domestic systemically important banks. And you see the numbers here across countries. So what are the key findings? We have 3 of them. Going to the next slide, please. The first is that indicators of systemic risk and moral hazard have moved into the right direction. We also find that effective too big to fail reforms bring net benefits to society, but we also see that there are gaps that still need to be addressed, and I'm sure that during this workshop we will talk about those gaps. Let me be more specific what we mean with regard to indicators of systemic risk and moral hazard that have fallen. On the next slide, please. So it's first of all, capital ratios of systemically important banks have increased by more than those of other banks, and that's clearly an effect of the reforms. Profitability of the systemically important banks has fallen, and that's to a large extent also the outcome of the reforms in terms of higher capital, lower risk, higher funding costs. I come to that in a minute. At the same time, lending has not declined, so that's good news. But we also see that complexity of global banks remains quite high. The next slide shows you just this increase in GSIB's capital ratios that I've just talked about. To see some differences across regions, but it's pretty uniform across the regions. The next finding on the next slide, that feasibility of resolution has improved. So we've gone a long way through different institutional aspects of this, and we've constructed an index of resolution reforms, implementation of resolution reforms. The data can actually be downloaded from the FSB website. And so without going into much detail here, the finding is that authorities now actually have more instruments, more tools, more options at their disposal if they're faced with a bank in distress. And we think that's actually also, although the report doesn't cover the period of the pandemic, that's actually an important finding also for the current situation that we're finding. We also have evidence that total loss absorbing capacity, TLAC, has increased for the systemically important banks. The next slide shows you the this resolution reform index that we've put together. The next slide, please. And what is interesting to see here is that, of course, there's variation across countries, and not all countries are fully there yet. So that's actually also one of our findings. But what is interesting to see is that when you look at the right-hand panel, that the GSIB home jurisdictions have done more than other jurisdictions. Perhaps that's what you would expect. So feasibility has increased. The next slide tells you about whether stakeholders consider resolution to be more credible. Again, this is something that we can't directly measure, but we look at some indicators. The most important one, estimates of implicit funding subsidies, which do have declined, and also a lot of indicators that market discipline has improved. So funding costs are now more aligned with risk of systemically important banks. This first finding, the implicit funding subsidies that have declined, that's what you see on the next slide. So we clearly see that in the period post the too big to fail reforms, the relative funding cost advantages are lower for the systemically important banks. But of course, you also see that if you compare to the period before the global financial crisis, the decline is less pronounced. And this decline is actually also correlated with the implementation of resolution reforms. The next slide is about, we can move one slide further, is about the net social benefits. And here this just gives you a very rough overview of the indicators we looked at. Obviously, we're interested in the social costs and social benefits, not the private costs of private benefits. And we find that the balance is positive here. On the next slide, you get some more detail here. So we've looked at the ratio of credit to GDP, which has not fallen. We do some reallocation of market share away from the systemically important banks to other market participants. We do see that market-based measures of systemic risk have fallen, and we do not see that there's been a reversal in the trend towards global financial integration. So we can actually move a couple of slides forward to go to the slide showing you the gaps that still need to be addressed. On the next slide, please. For those who thought that what I said so far sounds too positive, there's actually also a lot of issues that we identify, and I'm sure we'll talk more about this in terms of obstacles to resolution that can be further reduced, information that can be improved, and monitoring that can be enhanced. But I would like to stop here, and I'm really curious, and I'm sure the whole working group is, to hear from you where you think the reforms have succeeded and where remaining gaps. I stop here, and I thank you very much for your attention. Thank you.
Thank you very much, Claudia, for that introduction, which I think provides an excellent basis for our discussion. Let's dive straight into the first session on the credibility of the reforms, which is chapter 4 of the consultation report. And the overarching question at hand is whether market participants believe that a failing systemically important bank would be resolved rather than be bailed out. We'll hear from Sir Paul Tucker and then Alberto Gallo. Just as a reminder, if you want to participate in the subsequent discussion, please raise your virtual hand whenever you wish. Paul, the floor is yours.
Thank you, Dietrich. Congratulations to you, and congratulations to Claudia on the report. And I'm glad that so many people are watching today. I'm going to try and be very brief. I will make 4 points. The first is narrow and technical. I had some questions about the resolution index, which may be misplaced. I thought the marks for the US were high. For example, the US does not have requirements for internal TLAC. It is replicated something like that via the Title I exercise, but I think there is uncertainty around that. And also, and the US has not. And in fact, the FSB didn't recommend, which was a mistake, TLAC requirements for DSIBs. And the US has recently downgraded the statutory requirements for resolution planning by its large DSIBs. Now, I'm picking on the US because I think they probably are more or less ahead of the pack. They know this. I would score them at about 5 out of 10. That's the first point. And I think you should take that really seriously in terms of having an index that makes it look as though people have made terrific progress. The second thing is broader. So I don't know whether this is whether your policies are credible with the markets, because I'm not part of the markets. What I can say to you is that when you speak to some of the best analysts around the world, bank analysts, they don't follow resolvability very carefully at all. Someone said to me really quite recently they hadn't been asked a question about TLAC for really quite a long while. This is one of the top bank analysts in the world. I think that is partly because your community, the policy community, rarely speaks about resolvability and resolution. I mean, as chair of the Systemic Risk Council, I track to some extent speeches by the chief supervisors around the world. Very few speeches about resolution, and yet prudential supervision only exists in order to both reduce the probability and contain the costs of failure. I think there's something else as well which Basel could fix. The Basel capital structure is still far too complicated and lends itself to obfuscation and frankly rent extraction by investment bankers and analysts in terms of AT1, AT2, Tier 2, this, that, and the other. I mean, actually, there's just going concern capital and gone concern capital. There should be just two categories. And if you did that, you would help to focus, if the Basel Committee did that, and if I were on the FSB steering group again, I would be noisy about this, noisier than I was when I was on it, because I didn't anticipate the problem. I think if you did that, it would help to focus minds on what the true capital structure is rather than this complicated thing you've got. Now, finally, what do the market think? Well, I think the market thinks you'll still blink, really, when it comes to it. I think that what you've documented, Claudia, is a directional improvement in various spreads. But my instinct is that the magnitude of those spreads, relative spreads, is still small. And I think March will have fortified people in this. I think it is hard to explain the scale and rapidity of the market interventions by the major central banks. Actually, I think the ECB is completely different, but from the Fed and the Bank of England and one or two others perhaps in March, unless they were worried about one or two funds or near funds failing, and various names get mentioned around the market. I don't know whether that's true or not. And I think that in financial stability, we need the equivalent of a Paul Volcker moment in inflation. When will somebody be prepared, as Paul was with inflation, as my predecessors were in 1866, to let things fail if they're not systemic, and then support the rest of the market. And if there was support for non-systemic things in March, which I think plausibly there might have been, but I don't know that, then I think that the cost of that would have been to reinforce market perceptions that if any of the really big institutions gets into trouble, then you would blink. And if that's the case, I think that the West's attachment to a market economy is in real jeopardy. I mean, I think that this question of resolution transcends everything else that goes on in the Basel Tower. It's unless banking and dealers are part of a market economy that can fail, then the West's commitment to a market economy is not as strong. And given the geopolitical changes, I think that's a really big deal. So I welcome the report. I think the progress is okay. I don't think it's great. I think that top policymakers talk about resolution far too little, and I think it is inexplicable how little supervisors talk about it. And I hope that was under 5.
It was. Thank you very much, Paul. Let's directly turn to Alberto. Alberto, the floor is yours. Alberto, can you hear me? Alberto, can you hear me? We have your first slide on the screen, but I cannot hear you.
You should be able to hear me now.
Yes.
Okay. Thank you for having me. My name is Alberto Gallo. I run a global bond portfolio at Algebris, and at the firm we have around 12 billion in assets, and most of that is invested in credit, including bank capital across the capital structure, from senior to lower tier 2 and 81s. Too big to fail has not gone away. The problem was a banking system that would fail and require government help, as the colleagues explained. But in the financial system, we have banks and we have capital markets. And the solution has been to increase bottom-up capital in the banking system, one bank at a time. However, if we look at the banking system across different regions, we still have very large banks. We have a banking system that is between 2, 3, sometimes 4 times GDP. During the global financial crisis, banks that were affected the most lost between 5% of assets, 5% of balance sheets. So that's $5, not risk-weighted dollars, and a maximum of $8 roughly. Some banks lost more. The leverage ratio at the time was around 3. So you were losing 8, you had 3, and there was a shortfall of $5. But that has to be put in context of the size of the banking system, which many times was a multiple of GDP. So if your banking system is 4 times GDP, 5 times GDP, and you have a shortfall, then that has a bigger burden on the taxpayer. So from an idiosyncratic point of view, banks have more capital, even though this capital structure is very complex and non-standardized, but banks have more capital. So it looks like you have reduced the risk from a single institution point of view. However, at the aggregate level in the banking system, banks are still very large. In many cases, they lack profitability, they're very fragmented. And I would say that every banking system across the countries in this slide has a different problem. But overall, at the top-down level, when looking at the banking system size as a whole, the problem is still there. Also, it is very hard to believe that in a systemic crisis, you would be able to bail in all banks in a certain country or even all banks in a region, because you would completely enter a deflationary spiral. Loss absorbing instruments work. There is more capital, but they only work at an idiosyncratic level. And even then, there's been very different approaches comparing different institutions and different countries. If we go to the next slide, however, I would say that too big to fail, perhaps. I would like to ask you a question. Has too big to fail moved somewhere else? And the next one again, number 5. This slide shows you, if we go to exactly, this slide shows you the structural volatility in capital markets. We just had a 5+% sell-off yesterday in the Nasdaq and S&P. Together with bank regulation, we had a very strong and loose monetary policy effort by central banks with the implementation of forward guidance. This has caused herding, has caused some shift of risk from banks to capital markets. And what we're left with is a distribution of risk with a very fat tail. So in other words, you have more days of sun in the financial markets, but when it rains, it's a hurricane. And there are instruments that, albeit not regulated, can cause cyclicality, pro-cyclicality in the financial markets, and then also reflects on banks. So you have a lot more flash crashes, a lot more rapid moves, and bank balance sheets are still influenced by the moves in capital markets. There are instruments in capital markets that look like banks in the aftermath of the global financial crisis. In other words, they have a mismatch between assets and liabilities. And if we look at the next slide, I mean, we know what happened in Q1 2020 and Q1 2018. Risk-free assets have become positively correlated with risky assets. Central banks have become the only drivers of risk, so moving everything up or everything down. And if we have solved one problem, which is the problem of banks, perhaps we have also caused herding and lack of diversity in markets, which has moved the too big to fail problem somewhere else. We know what happened in March. If you go to the next slide, the Federal Reserve had to buy ETFs in the market, number 8, and essentially bail out ETFs and passive investments. And also we can show number 9, which has the chart of performance and ETFs going a lot below NAV. Exactly. So too big to fail is still there. I would say the TLAC reforms work at a single bank level, not at an aggregated level. We would not be able to bail in banks in a country or in a region. And the risk has moved, in our view, to capital markets. And there are other institutions which are not necessarily regulated as much, but they have the potential to create systemic risk, the way banks created it in 2008 and 2009. Thank you.
Thank you, Alberto. Let me now open the floor for comments, either on chapter 4 of the consultative report or indeed on what you've just heard from Paul and Alberto. Again, press the hand symbol if you'd like to comment, and I'd ask speakers to state their affiliation at the beginning. So let me just check with my colleagues. Do we have? I have Sebastian Schich from the OECD. Sebastian, would you like to come in? You are on mute.
Oh, I don't seem to be able to unmute myself.
We can hear you, yeah.
Okay, sorry. Well, thank you very much for the 2 excellent speakers, and also for the Secretariat for lining up these fantastic speakers. I'd like to ask a question to both of the speakers. Reaching back towards some of the work that Paul Tucker has produced earlier on, which is about this kind of interlinkages between the different concepts of basic values, welfare, powers and incentives, and where institutions should situate themselves in order to be sort of sustainable. But it's a question to both of the presenters, essentially. My question is that given what we have seen in this recent pandemics, and which is something that we haven't really covered in the report, but which I'm afraid will haunt us when discussing the final report further on, is the effect of the pandemics on banks and on also the readiness of public institutions to impose bail-in. And so my question really is, on the one hand, we have this the strong urge of public institutions to fulfill the short-term needs and support the economy in order to limit the fallout from what is really an exogenous shock. And so all the public support programs, they support forbearance and encourage banks to continue taking risks. At the same time, we have this more medium-term agenda of trying to instill bail-in expectations and also limit excessive risk-taking. And so my question is that, how do the pandemics change what we might have concluded from our report and our work on historical data, how might the pandemics change the perception of market participants in terms of whether the public sector is available to brutally impose bail-in, or, I mean, are we in a new regime now, or how can we cope with this kind of exogenous shock to sort of modify some of our conclusions? Thank you,
Sebastian. And let me remind speakers to be concise. Next is here Joni Aaltonen of AFME. Joni, the floor is yours.
Hear me? Sorry, can you hear me?
Yes.
Yeah,
yes,
great. Just one question really around the what Claudia referred to about the complexity. So obviously, on one hand, we have the central clearing, we have resolvability, we have clean holdco structures, multiple point of entry structures, and clearly the operational structures and operational resilience of banks has been increased substantially since the financial crisis. Then on the other hand, we have obviously in terms of the legal entity structures, we have subsidiarization of a lot of the branch network, mainly due to ring fencing of capital and liquidity in particular jurisdictions. So I just wondered if you could provide a little bit of detail behind the thinking of the level of complexity still remaining in the system.
Thank you, Joni. Any other comments? Hello?
Dietrich, maybe I can briefly say something on what we mean with complexity, just for clarification, because that was a question addressed.
Yeah, why don't you do that?
Yeah, so,
please.
So thanks for the question. So when we talk about complexity here in this specific context, we looked at the number of affiliates of globally systemically important banks, and that information was not easy to get. And we see that they're still very complex in terms of the number of affiliates, but you're perfectly right, there's many other dimensions. So we also have a section talking about the interaction between GSIBs and CCP. So we take note of these different concepts, but in terms of the quantification, we looked at the affiliate structure. Thanks.
Thank you, Claudia, for this clarification. I see Steve Cecchetti has raised his virtual hand. Steve, would you like to come in? Steve, would you like to come in?
Yes, thank you very much. Yes, I think this is first of all, I want to say that this is an excellent report. I think that the evaluation does an excellent, can you hear me? Can you hear me?
Yes, we can hear you, Steve. Please go ahead.
Oh, okay, thank you. Yeah, so the evaluation report, I think, does an excellent job of measuring progress on solving too big to fail. The question, I think, is what we should do next. And I hope that the FSB focuses on stress tests. The recent experience, I think, in both the US and Europe shows that these have enormous but as yet unfulfilled promise. The big challenge in addressing too big to fail, in my view, is pretty simple. In a long and damaging downturn, how can we use private funds to recapitalize an institution in a manner that ensures its ability to continue to serve as a source of credit in a healthy non-financial firms? And I believe that stress tests, which should apply to both domestic and global systemic banks, are an important part of the answer because they do two things, right? During normal times, they provide authorities and banks with information to set capital buffers. And during periods of heightened stress, the tests help resolve uncertainty and measure the need for additional equity finance. If we think about the second, which is where we are right now, stress tests are an essential element of a system in which intermediaries facing capital shortfalls are automatically recapitalized. And since this is done in a way that ensures continuity of service, it means that banks can fail the test, which makes them more credible in the first place. So as the FSB evaluation rightly points out, there's been a lot of progress, but to further reduce the likelihood of public sector bailouts, we now need to take the next step and exploit the untapped potential, I think, of stress tests as an important complement to the reforms that have already been put in place. My hope is that one morning I'm going to open my periodic email alerts from the FSB and that I receive, and there's going to be an announcement of the publication of key attributes on effective stress tests and automatic recapitalization regimes. Then we will know that too big to fail is further in the past. Thank you very much.
Thank you very much, Steve. I have 4 speakers on my list, and I would actually close the list there and then very briefly turn back to Paul and Alberto for any reactions that they may have. So first on my list is Nelly Liang. Nelly, you have the floor, and then Martin Hellwig.
Hi. Good morning, at least for us. Thank you for the comments on this. I had a question, I think that both Paul and Alberto raised, which is the consequences, maybe some unintended consequences of too big to fail reforms for the G-SIBs, and whether it has moved it to the non-bank, less regulated sector, or has, because the focus has been more on idiosyncratic individual banks, do you believe the system as a whole still is has not been resolved or too big to fail? Just your views and whether the events in March, how you interpret those. Thank you.
Thank you very much, Nelly. Next is Martin Hellwig and then Ryan Odud. Martin, please.
I'm muted.
We can hear you now.
Okay. I also would like to thank both the authors of the report and the presenters. On the question of feasibility, I wonder, are we talking about the macro problem or are we talking about the micro problem? Alberto's presentation suggested we really are talking about a macro problem, that at the level of individual institutions, things look fine. But if you think about the system as a whole, it doesn't fit together. In Paul's presentation, I wasn't quite sure. But from what I have observed myself, I would submit that we have still have very serious problems at the micro level. In particular, if you want to carry on operations, the question of liquidity provision is open, at least very much so in the European Union. And even when you talk about winding institutions down, the liquidity problem or funding problem is a bother. Now, to the back of this, you have political resistance, which comes in anytime there are vested interests inside the political system trying to make sure that the bank remains there. And what I do not see is any big change in stance on the side of the political authorities. So I wonder whether that doesn't have to be taken in as well. Resolution is not just a technical problem, but a political one.
Thank you very much. Next on my list is Ryan Odud from State Street. Ryan, you have the floor.
Yeah, hi, can you hear me?
Yes, very well.
Great, thank you. So, likewise, I'd like to thank the authors and indeed the presenters. So I think I just had a couple of small questions picking up on what Alberto kind of presented. So we mentioned kind of risk perhaps moving away from the banking sector to, other parts, on the capital market side. Perhaps, I would welcome perhaps some further clarification on, and maybe specifying, where you think that has gone to, because, one thing that we see, that gets dragged into this kind of non-bank and perhaps, capital markets broader kind of sector is obviously investment funds, but that's obviously a very highly regulated kind of like sector. So, we'd welcome kind of further specification there. And then just picking up on the point around ETFs and, is it correct to perhaps describe them as having been bailed out by the Fed when the Fed action, that they took under the SMCCF was in fact, targeted at the kind of a corporate kind of credit market underlying that, and the ETFs were rather used as a tool, to kind of like help them get exposure to that. So, just welcome some clarifications on those 2 points. Thank you.
Thank you. The next speaker is Stuart Graham of Autonomous Research. Stuart, you have the floor, please.
Can you hear me okay?
Yes, I can hear you well. And then I'll turn back to Paul and Alberto. Please, okay. Stuart, go ahead.
Thank you very much. Thank you to the authors and thank you to the speakers. I guess I just wanted to pick up on a couple of points. Point one, I mean, clearly progress has been made in terms of making individual banks safer, but I think Alberto made some very good points about the implications for the markets more generally. But I from my discussions with investors, and my firm is a specialist sell-side research firm, we just focus on financials, so I spend all my days talking to financial investors. I would estimate, and this is gut feel, probably only 25% of them understand TLAC and how it works. Most of them have very hazy knowledge of it. And I think very, very few of them think that regulators would actually allow a major financial institution to fail. And my evidence for that was a couple of years ago when there was lots of debate about Deutsche Bank. I can't remember a single investor who thought the German government would let Deutsche Bank fail. Maybe they were right or wrong in that, but that was my feedback. And I think what doesn't help in that regard is when you look at the contortions that Europe goes through on things like some of the Italian banks or some of the German Landesbank, and to avoid failures of what are not systemic institutions, that only leads to more confusion. So I would say definitely progress has been made, but I don't think we should kid ourselves that the market has really bought into as a thing of the past. Thank you.
Thank you, Stuart. Paul, would you like to react to some of the points that have been made?
So first of all, on complexity, I would make two small points. To solve the complexity problem, you're going to need to solve the problem of resolution of clearinghouses. And as you know, Dietrich, the Systemic Risk Council's view is what you've published on that is not fit for purpose, which is much stronger than disagreeing with it, not fit for purpose. Also on complexity, although I think counting subsidiaries is a good thing to do because it's the multiplicity of subsidiaries is unattractive for all sorts of reasons, I think it's really quite important to focus on resolution subgroups and ensure that there is more transparency around resolution subgroups. This goes to Stuart Graham's comments just now. My hope had been that market analysts would focus on single point of entry firms, multiple point of entry firms, and within single point of entry firms, whether they believed in the internal TLAC procedures for the resolution subgroups. But I don't think that's how the debate is conducted in the market, or indeed by officialdom. Secondly, on shadow banking, I think what Nelly says is completely right. For what it's worth, my guess at the time was that even without the requirements for GSIBs, just the Basel III requirements for regular banks, that quite a lot of leverage and liquidity transformation would have moved out of the banking sector. I think it's a crying shame that the FSB's work on shadow banking, well, about 3/4 of a decade ago, got bogged down in definitions of shadow banking rather than thinking about solutions, which I don't think are that hard. Actually, I think they're technically hard. I think they're politically a mountain to climb. And I think therefore March provides an opportunity if policymakers will get close to naming names about who they were worried about. I'm completely serious. The third thing I'd say is picking up a comment that Alberto made, and we've only got a few minutes each, so I think what he said about this is fine in the context. But there's this debate about will bail-in work for idiosyncratic situations, but maybe it won't work in a systemic crisis. This isn't binary. Crises are like Dante's circles of hell. Let me give you an example. Had bail-in been in place in March 2008, I think Bears could have been bailed in. In fact, I doubt whether JP Morgan would have wanted to buy the whole thing without a bail-in so that they could then pick the pieces off that they wanted. Had that happened, I think the incentives on Lehman to take outside capital during the summer would have been much greater, and the incentives for some others that I'm not going to name on both sides of the Atlantic to delever their repo books and derivative books and other things during the summer would have been strong. The point about systemic is, what if they all come together? And I think there is a power that the authorities don't have but could have, where actually you would simultaneously bail in a number of banks together. I think that would be a big political decision. And remember, at that level of systemic crisis, policy reform is about giving politicians a realistic choice between bail it out or have chaos. I think a technocratic elite that leaves elected politicians only with two completely unpalatable options is serving them badly. And I think technocrats ought to face the question, well, what if there are 2 or 3 or 4 or 5, or more or less together? What option, however hard, could be offered to the politicians, so inscribed in law, and they may not use it, but then they would be accountable afterwards. Why did you bail out rather than use this option you had? And that's the system working. And it takes me to, I think, the biggest question, which was both the first question and Martin's question about incentives. And I completely agree. This is all about political economy. One thing you should be looking out for is that unless the holders of bail-inable bonds issued by holding companies in the States and the UK and Switzerland, slightly more complicated in continental Europe, unless from time to time you see them putting pressure on G-SIBs to do this or do that to make them less risky, in the way that you see equity holders put pressure on banks to raise their risk-adjusted returns, but those bondholders should only be focused on risk. Unless you see that over the years, you can be confident that your system is not working. The second thing I would say is about that, and I think actually the BIS could do work on this. One of the tricks of monetary policy, trick is of course a very English way of putting it, over the quarter of a century from the 80s to just before the financial crisis, is how could monetary policymakers successfully box themselves in to do the right thing? And whether it's central bank independence or a transparent regime like inflation targeting or whatever, it was all about how do you box yourself in so that you don't require the moral fiber and courage of Paul Volcker. And it's how do you box yourselves in? And so if I take Italy, the fact that Ignazio did not have to resign is really significant. And it's not, I mean, Ignazio is a friend of mine, but you need to set yourselves up so that if you recommend to politicians, oh, bailout here rather than bail in, we won't use our regime after all, there is some cost to you as officials. And therefore, working backwards from that will fuel, in a realistic way, in a focused way, your work on ensuring these firms are resolvable. You need somehow to get politicians to beat you up if ever you go to them and ask for a bailout. And I don't see that going on at all. And yet it sounds like an outrageous thing to say, but it's exactly what we did on monetary policy, boxing ourselves in, so that if we cheated again, the personal costs to us as monetary policymakers would be high.
Thank you, Paul. Alberto, very quickly, any reactions, because we need to move on.
Sure. So I would say on complexity, again, there's still a lot of complexity in the banking system. There's one chart which we showed before, which shows the cross holdings of European banks, and it takes like around a day to understand it. I don't know if we can show it again to give you an idea of how banks are still very large. In Europe, they're over 30 trillion of euros of assets, but they're also very complex and very interconnected. So is it a micro problem or is it a macro problem? This is a very good question. And they are connected. If you have a sudden shock with all banks being affected, politically, bail-in is sometimes not the best option. But if the shock is more gradual, then we have seen that there's very different approaches. You know, Spain bailed in Popular, Italy had very hard political repercussions for bailing in two very small banks, and then no other bank was bailed in. This is let's not the other slide, please, with a lot of boxes. Number 5, I think, or 6. The other way. So is it a micro or macro problem? I mean, it's the next one again. Yeah, this one. So this shows you the cross holdings of European banks, and obviously it goes through the insurance companies, and so we have solved the individual bank problem, but we have not solved the systemic problem across the banking system. And also to add to the problem is the complexity across the capital structure of each bank, and also the complexity across the banking system as a whole, which makes risk very easy to propagate. Now, in capital markets, if we go back and we look at forward guidance, what's been happening is that as every crisis hit markets between in the last few years, if we go to page 4. Central banks told you we're going to be there. There's going to be a lot of days of sun, and investors said that's great. No more rain. I'm not carrying an umbrella anymore. And so forward guidance essentially encouraged herding, and it took out a key component of the market, which is that you have buyers and sellers. If you go to a fruit market, you have buyers and sellers. In financial markets, everyone is either a buyer or a seller, depending on the one driver of markets, which is central bank policy. And that's been the case since the start of quantitative easing. So the lack of diversity, the use of aggressive forward guidance has made markets very binary. And obviously, financial markets are connected with banks. By reducing volatility, central banks have encouraged investors to believe that tomorrow will be always the same as today. But this creates also a much bigger shock, a much bigger surprise when things change. And so coming back on the question of ETFs, has the Fed bailed out ETFs or the bond market through ETFs? It's hard to disentangle. It's a chicken and egg question. Imagine if you had an ETF on a very illiquid underlying. So we have ETFs on high yield bonds, which are 3% of the market, and investment grade as well. And these bonds are traded over the counter, so they're not very liquid like an equity. Imagine you had an ETFs on property, and these ETF fluctuated in price every day, and it would cause panic. And then at some point, the Bank of England or the Fed had to bail out the ETF. Otherwise, with a big decline, the ETF would be forced to sell houses to buy back its shares, which is essentially the mechanics of credit ETFs. There are instruments that have a liquid holding of assets, a liquid liability, so shares in the market, but have an illiquid underlying holding of assets. And when you think about credit ETFs, they can procyclically give you the impression of liquidity, but in a sell-off, they actually accelerate the moves in the market together with lack of diversity in risk-taking. If you had an ETF on property and the stock market went down and the ETF on property went down, and then the ETF would be asked to sell houses every day at any bid, then would the Fed bail out the ETF on property or the property market itself? Well, we don't want to be in a position to ask ourselves this question. And that's why I think we want to be in a position where preventively we want to regulate or at least put some limits on instruments which can become very procyclical and are very fragile in the banking system. So you know that if you have a large share of the credit market in ETFs which are procyclical, that can have a feedback loop impact during a sell-off. And that's one of the many things to flag, together with strategies that are based on selling volatility, like we saw in Q1 2018, and strategies that are based on a levered view that correlation across different assets will stay the same in the future. So I think that covers some of the interesting questions that were asked. Thank you.
Thank you, Alberto. And we are already running behind schedule. Nonetheless, I would like to take up one question that has been raised by Wilson Irwin from Credit Suisse to Paul Tucker. And Paul, I would ask you to react very, very briefly, if possible. The question is, I fully agree with you that there is more concern now that authorities may blink. Indeed, they have been blinked for small Italian lenders. But you've said that large US G-SIBs were resolvable as early as 2013. Since then, TLAC is much greater, bank structure is simpler, and stays have been implemented. Do you think that has gone into reverse?
No, I don't. I think it was technically feasible then, and I think it's technically feasible now. The questions I've raised are about will and about boxing in. And it's when I raise questions about will, I'm not making points about the character of the particular individuals concerned. I'm thinking about how on the monetary policy side, great effort was made to kind of bind institutions through a contract or through appointing particularly conservative people in a financial monetary policy sense. And I don't see the same effort to build policy institutions that will use the tools that they unquestionably have, and I believe could work and should work under duress. You have to be prepared to be unpopular to do the right thing. And I think there needs to be some investment in institutions and institutional design to help that. And I think your community is the only community that could lead this. So far, I don't see you doing it. I implore you, plead with you to do it.
Thank you very much, Paul. And we need to move on, notwithstanding the very interesting discussion, to move on to the second topic, how banks have responded to the reforms, which is Chapter 5 of the consultation report. For this session, we have Viral Acharya and Tomo Ishikawa to give introductory remarks. Before I give the floor to Viral, please let me remind participants first to be concise in their comments, and again to emphasize that we are considering the focus and purpose of this workshop, namely to provide feedback on the consultation report. We are very much interested in particular on comments on the evaluation. With that, Viral, the floor is yours. You are unmuted now, I think. But we cannot hear you well. There seems to be some sort of staccato.
Okay, I need to be able to share my content, but I don't seem to have the option to.
I can see you, but can still not hear you well.
Yeah, can you hear me?
The bandwidth, now it is better, but the bandwidth seems to be low, so you may consider switching off your video.
Okay. But I need to be able to share my content, and I'm not able to activate that button. I don't know if I have the rights to share my content.
It's now up, and we can hear you well now.
Okay, great. Thank you. I wanted to give a summary of the report viewed through a very particular lens, and then maybe I can conclude with some remarks on what perhaps is going on in the banking sector and the system as a whole. to some of the concerns that both Paul and Alberto have raised. If we go to the next slide, at NYU Stern, we have been using a very specific measure to assess the measure is how much the financial sector in different countries have if there was to be a very large global correction. This looks like a stress test. We are not inside regulatory institutions, so we have to use market data to construct the outcomes of such a stress test. And just in words to explain the equation that is out there, we measure the S risk first of an individual institution. It's the capital that this institution would need to raise in the event of a crisis. And I stress not just to survive, but to function normally. So we looked at, say, JP Morgan in 2008 or HSBC in fall of 2008. They were still maintaining market capital ratios on the order of 7 to 8%. Okay? And so that's the parameter K in the equation there. Given what balance sheet size you will have in a large global stock market correction of worse than 40%, would you still be holding 7 to 8% of your capital? Or will your market value be eroded so heavily, that's by that LRMES term, which is your downside risk to the market, will your market capital be so heavily eroded in a downturn that you will not be able to meet this implicit 8% capital requirement of the market? Now, why am I doing this? I want to show you how this measure has evolved over time, because I wanted to offer another quantitative market-based measure to the evaluation of the too big to fail problem. And I want to stress that the focus should not just be on whether institutions survive. The focus should be on whether they can continue to provide healthy intermediation to the economy. There are lots of zombie financial institutions in the world. We can prevent them from failing. That's not good enough. Okay, so let's look at Europe. In case of Europe, this number peaked at around 2 trillion of capital requirement in end of 2008. Unsurprisingly, this number was actually very close to that level during the European sovereign debt crisis. And since then, there has been a substantial reduction in the estimate of the capital shortfall of the European banks. At present, it is around 1.5 trillion. Some of the gains have been eroded again since 2018, as you can see, with a substantial rise in the capital shortfall estimates over the last 6 months. So here, overall, I used to conclude for Europe that the progress is mixed, because it wasn't as sharply declining as I would have liked. Nevertheless, it's still below its peak levels of 2012 and 2009. Now, if you go to Asia, in contrast, the conclusion is exactly the opposite. The capital shortfall for Asian banks has just been rising, except for the short market. It's essential for banks and break up the measure into what's causing the change, and they've just been levering up very, very rapidly. And this is something I want to highlight, that we have a tendency in our reports to focus on developed economies, but it could very well be that the financial sectors in emerging risk in Asia and China. And the world may have to think about what's happening with the Chinese banks. Now, let me turn to US, because this is the one I want to focus the most on. That's on the next slide. In case of United States, if you look at the measure, if you look at the top graph and focus on the red line, you can see that United States appeared to have made tremendous progress since fall of 2008. from a peak of close to $1 trillion, the capital shortfall estimates had come down to as little as $100 to $200 billion in 18 and 19. And yet, the moment the pandemic hit, actually, the biggest shock to me has been how rapidly the capital shortfall estimates for the US banks have risen. They've actually risen to very close to the collapse of Lehman Brothers estimate of $750 to $800 billion. I think this is also reflected in a fairly violent stock market reaction of the US bank equities over this period. Now, what I've done with some of my colleagues, and it's mainly my colleagues Rob Engel and Tian-Yue Huan who have done this, is that you can ask the question. Romer and Romer in their 2017 work estimated an index of 0 to 15 on the credit market disruptions in a particular country. How much was the credit market stress? Then you can take their index of 0 to 15 and relate it to the S risk of countries with, country fixed effects and so on. Using that, you can estimate what level of S risk would cause the probability of a credit market disruption. So the definition of a crisis is not failure. It is actually tight credit. What level of crisis greater than 0.5? And what you observe based on these estimations is that the US right now is close to an 80% likelihood. The likelihood was 100% in fall of 2008. And I can confirm to you personally, with my experience in trying to refinance my mortgage, I think I'm a reasonably decent credit, and it's been very painful, and it hasn't yet happened. So in terms of US banks being healthy enough to provide good intermediation to the US economy in the midst of the pandemic, it seems in spite of all their gains in this capital shortfall measures until 2018, something has gone awry. And let me try and explain what might have gone awry. And this relates to my main point on perhaps how the financial system as a whole has responded to too big to fail. If I could look at my last slide. I think what has happened is that the risks have indeed moved to shadow banking. And let me explain this. I remember when I was talking about shadow to my son, one of the characteristics I explained to him was that the shadow always touches the feet. It's been my observation that the shadow banking is ultimately always functioning on the back of the banking sector. Bank finance has an automatic stabilizer in the form of deposit insurance and the central bank's lender of last resort. And so as long as shadow banking starts offering immediacy of repayments, in a market stress scenario, there will be rollover risk, there'll be freezes, they'll become too systemic to fail. And there are two important ways in which this gets transferred to the banking system. The first is contractual. And this has happened in the COVID outbreak. We have discovered this in the COVID outbreak that essentially almost all corporations relying on the market instruments for their financing had large credit line facilities provided by the US banks. These facilities were drawn down at unprecedented pace by these corporations, creating a massive dash for cash and bank credit line drawdowns. Bank capital, as a result, got contingently locked up, and there was a very massive correction of the bank stock prices. They simply don't have adequate capital to maintain regulatory standards and yet be lending well to the real economy, as highlighted in the $800 billion figure for the capital shortfall for the US economy. So that's a direct transfer through flow of funds from shadow banks to banks. And of course, we know that the central banks also provided a massive lender of last resort, not just to banks, but also to the shadow banks. But perhaps both are important. And I think herein, lies the biggest sort of elephant in the room for me. Central banks have been collectively engaged in trying to make banks very safe. But I think through their expansion of balance sheets, they have offered such a massive put to the markets that actually they have themselves shifted the problem to the shadow banks. I think the moral hazard of extraordinarily large central bank balance sheets, willing to do whatever it takes to achieve whatever the mandates might be, means that I think aggregate risks are not priced in the markets anymore. As soon as aggregate risk materializes, markets are freezing. The central banks end up doing exactly the same kind of bailouts that we were used to giving to banks. Some risks are moving to banks through lines of credit. And I think this is something that we need to take into account, because if we just solve the too big to fail problem narrowly in the context of banks, the system will just find a runaround as long as moral hazard of central banks stepping in to take over aggregate risk is there in one form or the other. Thank you.
Thank you, Rival. And let me directly move on to Tomo Ishikawa. Tomo, please, the floor is yours.
Thank you. Thank you, Chair. Do you hear me okay?
Yes, very well.
Excellent. This is Tomo Ishikawa, the head of Global Reg Affairs at MUFG. MUFG is a GSIB with a global footprint headquartered in Japan. The discussion has been very interesting, given the different comments from different angles. But let me give you an observation of how we view this report from a practitioner's perspective. This report is no doubt an empirical-driven, data-driven, analysis-driven piece, all important and relevant in the evaluation process, but to be blunt, fails to take into consideration an anecdotal and indicative evidence. Don't get me wrong, I'm not trying to undermine the data-driven exercise, but if we step back and think of what outcome we hope to achieve as a result of too big to fail reform, it is to make GSIBs resilient, less systemically relevant, less complex, and resolvable. These are the outcomes you want to see. What inputs would our senior management look at when making key strategic decisions? They do not rely on the data set shown on this report. The reality is we put higher emphasis on anecdotal evidence and indicative evidence. If we sense an early warning signal, we act. If we sense a significant unintended consequence by taking a forward-looking approach, we act. That's the way we make decisions, and I bet the same applies to policymakers and regulators as well. For this reason, in the context of evaluation, you need to approach from two angles. One is a data-driven exercise, but also more anecdotal evidence-driven analysis. You need to take two to come to a right conclusion. Let me give you two anecdotes that I hope policymakers will take into consideration when discussing what additional policy measures are required. First, and you guys discussed this a little bit, which is corporate complexity. GSIBs have rationalized the corporate structure. I know the FSB members acknowledge this, but the number of entity isn't the problem. I think the ownership structure and the alignment with the resolution plan is more relevant. I think earlier speaker touched on this. For example, if a holding company, let's say, owns one subsidiary in Japan, which owns a subsidiary in the US, which owns a subsidiary in the UK, which owns a subsidiary in the EU. Let's assume that. If the ownership is a long vertical chain, I don't think a supervisor would be comfortable, because if you're a supervisor supervising the entity at the bottom of this vertical chain, you need to wait for the 99 parent to make decisions, which will take definitely a long time. On the other hand, if a holding company owns the material subsidiaries, as defined by the FSP key attributes, even if the number of entity may be more than 100, the corporate structure is coherent with the resolution plan, so the chance of an orderly resolution is significantly higher. So in terms of judging the complexity, merely counting the number of entity isn't the right approach. Whether the structure is aligned with the resolution plan or not is more relevant. Why? Because the policy outcome we wanted to make is to make GSIBs resolvable, not reducing the number of entities. Second, on the resolution planning, making GSIBs resolvable is the goal you want to achieve. The FSB and its member authorities are urging GSIBs to do more to address the remaining gaps. I oversee regulatory policy and the recovery resolution planning at the MUFG. So I know the team is working hard to finish the job, but I do hope the policymakers appreciate the significant progress we made over the past decade. Given where we stand, the remaining gap is shrinking, but last 1 mile is quite challenging. Most GSIBs resolution strategies are based on the single point of entry. It means the resolution will take place at the top level resolution entity, mostly a holding company. The term single point of entry may give you an impression that there is only one resolution plan. The reality is no, that's not the case. At our group, we have more than a dozen recovery and resolution plans. Some are not disclosed to us, so we don't know the details. These plans have to be updated on a regular basis, but the timing isn't aligned. I have to review and sign off recovery and/or resolution plans every month. The effort to address the remaining gap would be distracted due to the number of the plans that need to be updated. I do think there's a room to improve this. The industry often asks for more coordination, cooperation between the home and host authorities, and this is a great place to start. The home authority and the CMG members can collaborate on resolution planning to ensure there is an alignment across the board. If we only have one plan for the group, we can focus on the remaining gaps to make the bank fully resolvable. You may think my suggestion has nothing to do with the evaluation of too big to fail reform, but as I have indicated, the anecdotal evidence is a factor that influences the management decisions. The fact that we are required to produce more than a dozen recovery and resolution plans indicates that the home and host coordination isn't progressing. These plans require you to have capital and/or liquidity in host restrictions, so a source of prepositioning and ring fencing. Not a good sign when discussing an optimal resource allocation. Before I wrap up, let me stress that the too big to fail touches on many aspects of the regulatory agenda. This report, when finalized, should indicate the areas where further work is necessary and let the respective standard-setting bodies to complete the work. On the issue I touched on, i.e. the corporate complexity and recovery and resolution planning, the RESG at the FSB may be the relevant group to finish the work, but there is an aspect of fragmentation concern, so the SRC may also be the right body. I do hope the two working groups will receive the baton from Claudia and to address the gaps I have touched on. Thank you for your attention.
Thank you very much, Tomo. And I think we've heard two quite different, very rich perspectives on the topic at hand. Now, we are running significantly behind schedule. So what I would suggest is that we open the floor for a handful of comments. So please raise your virtual hand if you want to comment on what you've heard by either Tomo or Viral, and then directly move on to the next session on the broader effects. We have about 40 minutes left, and we really need to cover this third important topic. So with that, let me open the floor. George Penacci. George, please, you have the floor. You are muted at the moment.
I'm muted?
Yes, now we can hear
you. Of banks, and that it's based on...
George, could you start again? You had been sort of remuted again for a couple of seconds.
Okay, thank you. I wanted to pick up on Varel's measure of stability using market value. The S-risk measure is primarily based on the market value of bank equity, but our regulatory measures tend to focus on book values, and they give mixed signals. I was just wondering if Varel, how do we reconcile these two different signals? Because I think the focus of supervision and regulation is on book values, but we seem to be getting very different indicators based on market value. And I think when it comes to crises, it's the market values that's lead to a loss of confidence in the banking system. Thank you.
Thank you, George. Next on my list is Joni Aaltonen. Joni, please.
Thank you very much, Dietrich. I want to touch about the same points about the S risk. Obviously, it's market valuation measure, and clearly one of the key problems here is if you look at the S risk measure before the financial crisis, it was very low for a long period of time, so it didn't indicate any problems based on the S risk coming out in 2007 or 2008. Secondly, clearly, if you look at the S risk measure, it's high now, and clearly one of the key reasons for that is the bank profitability, and which is at the heart of the problem at the moment. And again, we've seen policy rates go down, bank business models being again under stress. So the S risk and the market valuation of bank shares has been under pressure, but it is more a profitability issue in many cases rather than systemic risk issue and probability of bank failure issue. And in terms of bank profitability, so if we continue on that trajectory of bank profitability, then naturally banks will not attract more capital, will shrink again compared to the rest of the market, and their market share will drop because they can't attract the capital investment, and clearly that will be detrimental for their business models. Again, that will have systemic consequences, and I think that's the bank profitability and the wider share of the market that large banks have is something that should be also addressed in the final report. Thank you, Dietrich.
Thank you, Joni. Next is Martin Hellwig, and then I would very briefly turn back to Viral to quickly, but please really quickly respond to the points made relating to S risk. So, Martin, please.
Can you hear me?
Yes, we can.
Okay, I would like to ask about single point of entry. Tomohiro said this is essential and it isn't working. Now, the reason why it's not working is, of course, that the political authorities in different countries don't like it and want to put limits on them. This gets back to the first panel, politics. What do we do if single point of entry is politically non-viable and we have multiple authorities wanting to step in?
Thank you for this question. Viral, would you like to respond to some of the earlier points made? But again, please, in the interest of time, briefly. Yeah.
Yes. Thank you. Are you able to hear me?
Yes.
Can you hear me now? Or?
Yes.
Yes. Okay. Yeah, I agree with the point on market values versus book values. The disadvantage of market values is they will tend to be somewhat pro-cyclical because risk is pro-cyclical. The disadvantage of book values is that they may just be too flat. And, you know, especially we know that all kinds of accounting forbearances come into play when a shock hits, and banks are not required to mark assets to even expected losses at times. So my view on S risk has been very simple, that it seems to be related to measures of banking sector stress as measured in credit market outcomes. And in fact, that is what I was showing you, that S risk actually predicts when the Romer index of market disruption actually becomes large. And so even if it's a realized measure, as long as it's a descriptive measure that helps understand when crisis rises, for me, that's sort of good enough. I fully agree that it was looking benign before 2018. Part of it is the pro-cyclicality of market values. But I think the second reason is what I highlighted. We need to go back to the blackboard and think about how to factor in contingent risks coming in through credit lines into our S-risk calculations. In fact, I was implicitly highlighting that the reason why S-risk grows so sharply is because the shadow banking risk of bond markets actually ended up on bank balance sheets through drawdown of credit lines. And this is something that this episodic ignition of contingent risk into bank prices and balance sheets is not something that we had so far carefully thought about.
Thank you, Viral. And we'll come back to some of the questions, specific questions that have been raised, either sort of on this virtual meeting or by email after the call. So now let's move on to the last topic of discussion today, which is the broader effects of the too big to fail reforms. That is chapter 6 of the consultation report. This is obviously a potentially enormous topic, and as you've seen, chapter 6 covers a lot of ground, including the structure and resilience of the financial system overall. Touched on that already in a number of interventions, interconnections between banks, cross-border lending, and overall costs and benefits of reforms. So for this session, we have Maria Sole Perea and Thierry Philipponnat for the introductory remarks. So let me directly give the floor to Sole. Sole, please, go ahead.
Thank you very much. Can you hear me okay?
Very well, thanks.
All right. Well, thank you very much for the opportunity to comment on this very interesting and relevant report. I want to start by making the usual disclaimer that the views I will share are my own and not those of the IMF or its management or board. But before I turn specifically to the chapter I have to focus on, let me just make 3 overarching comments on the report. First, while it seems very important to assess the impact of the too big to fail reforms, especially given that a decade has gone by since the GFC and the start of the reform effort, I think we still have to keep in mind that the implementation has only recently began in many cases. So trying to draw conclusions as to their effectiveness right now might be premature, especially for some jurisdictions. So I think that's important to keep in mind. Second, while I think the report acknowledges the difficulties in separating the effects of too big to fail reforms from other reforms or factors, it should bring us pause in separating, these reforms should bring us pause in drawing any firm conclusions as to the impact of too big to fail reforms. So I think in general, when we discuss some of the findings, we should at best be talking about associations and not causal effects. And third, even with the caveats mentioned, let me say, as I think was highlighted also by Viral and others, that certainly the current crisis seems to be an excellent opportunity to go further into investigating the too big to fail reforms. Because even if it's useful to examine where the funding cost advantages for GSIBs have changed since the GFC, or whether bail-inable debt is perceived to be riskier than other instruments in normal times, I think things might change rapidly during a crisis, and this is when we want to see whether, in fact, there's been changes, and whether, in fact, the perceptions about too big to fail and the pricing accordingly is different relative to, say, the previous crisis or to normal times, and whether, in fact, we observe that resolvability has improved. So with that, I hope that the evaluation effort will continue and consider what we are observing today. So with that, let me just make 4, I hope, quick comments on the chapter specifically. First one is the issue discussed on the impact of too big to fail reforms on financial sector concentration. And I think it's not entirely desirable it's not entirely clear what would be the desirable effects. So certainly we want to see a reduction in complexity of banks and resolvability, but at the same time, the chapter reads as saying that in general concentration, and by that I mean not just the market share of the GSIBs, but more generally is bad for stability. However, I think the chapter should recognize that there's been a debate in the literature and that there would be some that argue that concentration could enhance stability by increasing charter values and reducing incentives to take on risk, especially if the perceptions of too big to fail are kept in check. So I think it would be good if the chapter acknowledged these views and sort of around the impact on concentration. Second, on the question of whether the reforms have led to a decline in systemic risk, the evidence suggests that there might have been a decline with all the caveats that we've been discussing about S risk and other similar market measures. But it would be great if there could be more evidence as to whether the observed decline measures following the crisis are in any way correlated with the introduction or intensity of the reforms, which is not something that currently I see the report as doing. Third, given that as stated, the objective of the report is to look at the broad, not the report, but the chapter specifically, is to look at changes to the financial system and the economy at the end. I found the discussion on market fragmentation and internal TLAC, while very interesting, was a bit misplaced relative to the broad objectives of the chapter, since it only discusses implications for GSIPs as opposed to the broader economy. Finally, in the section discussing the social benefits or cost of the reforms, the discussion of social benefits could perhaps consider not only the impact on perhaps lowering the probability of crisis and implications for credit and GDP, but also mention more specifically the potential fiscal savings involved if systemic banks can be resolved without government resources. And moreover, the quantification of social benefits and cost is a very important issue, and it would be useful to know more about these numbers, and in particular, how they might change if some of the assumptions in the framework that is being used right now were to be relaxed. For example, as the assumption that higher capital cushions have no impact on the interest that a bank may pay on its borrowing, or that all the cost of increased capital requirements are assumed to be passed on to a bank's borrower without those borrowers moving to competitors. So these assumptions are, strong assumptions, and I think it would be good to sort of see what would happen to some of the calculations that are presented if one were to relax some of these assumptions. So with that, let me stop, because probably my time is up, and thank you for the opportunity to present my views, and I look forward to the discussion.
Thank you so much for these comments. Let me turn to Thierry. Please, the floor is yours.
Thank you very much, Dietrich. Very happy to be here and to share my views, which, incidentally, it's the beauty of the organization I work for, are the views of Finance Watch. I would like to make a brief comment on the report in general before I turn to Chapter 6, which is the topic of our panel. This report is incredibly informative, useful, I would even dare say indispensable. Having said that, it would have been interesting to make, in my view, a distinction between the analysis of the overall resilience of the banking system, where granularity in the assessments can and should be introduced, and TBTF, which at the end of the day is very much a binary affair. There's no doubt that the various reforms that have been implemented over the past 10 years have improved significantly the resilience of the system. Mind you, we're starting from very low basis, but it's been improved tremendously. Having said that, TBTF is still with us, despite the fact that everything else being equal, the probability of a global banking crisis is lower today than it was, say, 12 years ago. And the report recognizes that, because when it says there are still gaps to be addressed, effectively it recognizes that the binary concept of TBTF is still there, and the job of getting rid of it is not done. So at the end of the day, key question is, can large banking institutions survive without public support? And the answer is no. Interestingly, we usually think of public support to banks as the bailout of banking institutions out of public budgets. If I may invent an expression, I don't know if it's an invention, but I would call that a fiscal bailout of banks. But the interventions of central banks, say in reactions to the COVID crisis, show us that now there is the concept of monetary bailout of the banking system. If it had not been for the massive intervention of central banks following the COVID crisis, we would be in the midst of a terrible financial crisis. So a number of speakers before, in particular Viral, said very rightly that, didn't use the expression, but the Greenspan put of whatever, 20, 30 years ago has now transformed into a Powell and a Lagarde put. Fine, fair enough. That means that markets have become too big to be let down, but effectively that translates into something which is not considered, but that should be essential in our reasoning, which is the fact that those very large banking institutions cannot stand alone without public support, and that's something to be considered. Now, if we turn to chapter 6, and effectively trying to look at the resilience or the impact on the resilience of the system, the structure of the system, and the social costs and benefits, I will highlight very quickly 3 or 4 points. To me, the three biggest consequences of too big to fail are, one, during crisis times, sorry for stating the obvious, the cost to society of the bailout of banks, fine. But more importantly, I would say, or as importantly, outside of crisis times, there is that famous funding subsidy and its consequences. It distorts the structure of activities on banks' balance sheets. And the other thing is the implicit support of banks that otherwise would not be viable. You can call it imposing market discipline, you can call it sorting out the wheat from the chaff, you can call it not supporting zombie banks, but at the end of the day, if you believe markets should have a job to do, which is put a price on a risk, too big to fail is effectively anti-market. Very importantly, those 3 undesirable consequences of TBTS are still with us, as very well highlighted by the report when it says that, it shows that the implicit funding subsidy is more or less where it was before the crisis of 2007, 2009. And effectively, that's the period we're interested in, because this is the period where everything that we know built up into what ended up exploding. To a large extent, getting rid of TBTF comes down to implementing credible resolution regimes. We've gone through that and making resolvability possible. We've gone through that. We'll go very quickly, but that has consequences on the effect and the broader effects of the reform. The main 2 issues, and that's something the report is really good at highlighting, is the organizational complexity of large banking institutions, which makes resolvability at best very difficult. And the other topic, which has not been raised today, but which is very clear in the report, is the lack of complete information on who owns TLAC debt. And we have, resolution authorities have a partial view of that, which comes down to driving blind or driving with only one eye open, which, to say the least, is a bit frightening and makes the whole thing not very credible. Martin Helvig and Paul Tucker, at the end of the day, said the same thing when they said, well, Martin said, resolution is not only technical, it's highly political. Paul Tucker said you have to be ready to make yourself unpopular. They're saying the same thing. If you want to make yourself unpopular, and yes, resolution by definition makes someone unpopular, don't ask politicians, whoever they are, to do it. By definition, a politician cannot be unpopular. So, and this is why, take the example of the EU. The EU has a technically, I'll make much longer story short, valid way of resolving bank. BRRD makes sense, etc., etc. But politically, we don't know how to resolve a bank in the EU. We've had one case, not of a GSIB, as we know, of proper resolution in the EU, and the other case is, it was not called bailout, it was called precautionary recapitalization. But take the Italian or the German examples, and there are other examples as well. We have not been able to bail in those institutions. So, that is very important. Going back to the consequences of too big to fail, I was explaining earlier, which is the distortion of banks' balance sheets and market activity. To call a spade, if it were not for too big to fail, we would not have such a large derivatives market. Derivatives market is an oligopoly of 15 banks, which are all G-SIBs, and effectively, if they can have such large market share in trading of derivatives, it is because they have the implicit state support behind them. And there's nothing wrong in principle with derivatives, apart from the fact that creates the interconnectedness in the system. Yes, there is the CCP dimension. I don't have the time to go into that, but we have to be conscious of the fact that that distorts the structure of the market. If we go into the essential question, I'm conscious of time, of the social costs and benefits of too big to fail reforms. The report says, interestingly, that there's been a net benefit of TBTF reforms of 0.09% of GDP per annum. Yes, fine. I'm not certain that 0.09% is statistically significant, but let's not go on that. I've no doubt that there's more benefit than cost. And if anything, and that's extremely difficult to evaluate, the benefit is really the cost of avoiding crises. And crises, I don't think I need to develop on that given the crowd today, but have an enormous cost to society, and the benefit of not having to pay that cost is essential. Very importantly, and this is my very last point, the benefit to society of getting rid of TBTF is compounded, in my view, by the risk to financial stability posed by climate change. In the context of stranded assets, and given the climate finance vicious circle, do call it what you want, where finance makes climate change possible and at the same time is threatened by climate change, the benefit of avoiding a new financial crisis on top of a climate crisis will be enormous. In that context, the TBTF issue is particularly relevant, given that banking exposure to the fossil fuel industry, and we're talking trillions of dollars here, is mainly on the balance sheet of G-SIBs and to a lesser extent D-SIBs. So if we can avoid to add a financial crisis and a too big to fail crisis, or fed by a too big to fail crisis, to the announced climate change crisis, it would be tremendous. Hence the importance of going all the way down to resolving the too big to fail problem, and not satisfy ourselves saying we've gone a long way. Very happy to discuss.
Thank you very much, Thierry. We have, if we take 10 minutes from the concluding session, then we have 12 minutes left for discussion. Let me first turn to Kenichi Ueda.
Hello, can you hear me?
Yes, we can hear you. Thank you.
Thank you. My name is Kenichi Ueda, currently at the University of Tokyo. Before I worked at IMF, where I actually produced, together with Beatrice Veda Di Mauro, one of the first papers to estimate too big to fail subsidy values. And also I was a lead chapter author of the IMF 2014 chapter on GFSR chapter on too big to fail subsidy. So I think I have something to say this time again. First, as I do agree with Sir Paul as well as Professor Hedwig, and just had Thierry Philipponnat, I do agree the political economy is important. We have always talked about it even 10 years ago. It's all about political economy. And I do believe, and at that time also I did believe, that in the end, whether the Deutsche Bank or Citibank or Mitsubishi Bank would be bailed out or not is solely in the hands of politicians. And most likely, I think, highly probability that still happening likely happening if something bad happen in the near term in the economy of those countries. But anyway, as a technocrat, as a researcher, our job, I think, is to, given such political economy, what kind of design of the system we can make. And what we thought, and I think I still think, is to, important thing is to ask those banks or financial institutions have more capital buffer, so that even there's some big negative shock happening in the economy, that banks or financial institutions can survive, so that there's no need even politicians to help them, because they can help by themselves, right? And so that evaluation of the system reform, I think, need to be two tiers. In the first tier is a tranquil time. Whether in a tranquil time have we succeeded to lower the so-called hidden subsidies to systemically important financial institutions. If so, we can say it's a success, because that's really a measure of distortion in the tranquil time, as well as measure of distortion in terms of moral hazard and so on. The second tier, which is more difficult, is to evaluate whether in a crisis time, indeed politicians wouldn't not bail out or not. But this is a political economy and decision. It's kind of difficult to difficult to have that kind of status from the just technocrat and economist researchers kind of powers. So that the second one, we should keep this two-tier kind of evaluation in our mind, and then I hope that's more kind of productive things to do. Thank you very much.
Thank you very much, Kenichi. Next on my list is Mark Flannery. Mark.
Can you hear me okay? Can you hear? Whoop.
Yes, it's fine.
Okay, thank you. Many people have said that this is as much a political economy problem as an economic problem. And Paul said earlier on that we need to provide the politicians something more than a choice between two terrible alternatives. And that brings me around to the discussion of that George raised about the importance or the relevance of market value in S-risk versus lagging book values or accounting values. And there, I think that what we can do is we can try to use the stress tests that Steve Cicchetti was talking about, or something like the stress tests, to provide a continuing estimate of how accurate the market estimates of capital are. Because as we all know, the problem is not only that the market has lost confidence in a bank, but the book value says that the bank is thoroughly solvent and completely consistent with capital requirements. So if we could use something like stress tests to pay more attention to the accuracy of the, I think that would give the politicians a much richer set of early opportunities to act. Thank you.
Thank you, Mark. I had seen Martin Bohr raising his hand. He seems to have lowered it again. So Martin, if you want to come in, now is the opportunity. And then the last speaker on my list is Bill Nelson. Martin, do you want to come in?
Yes, can you hear me?
Doesn't seem to be the case. So then let me turn to Bill Nelson. Bill.
Okay. I heard Martin, I think.
Ah, I couldn't hear him.
Yes, we heard him.
Yes, thank you, Dietrich. This is Martin from the IF. I just wanted to comment briefly that we very much support the report, especially the findings in terms of the benefits of a TBTF. In terms of the costs, we do note that there was not sufficient focus perhaps on liquidity, which was mentioned earlier. but also in the scope of this panel, we think there could have been more evidence and indicators in terms of what the social costs have been in terms of the TBTF reforms, some of the ring fencing, some of the trapped capital, and what that has meant for social costs. Separately, we wanted to underscore the points that Tomo made, that this is very much part of the broader FSB market fragmentation work, and we very much support you looking further under that work stream into things like the distribution of internal TLAC and those sorts of other TBTF related issues. So we very much hope that when this report concludes and when the recommendations are made, that they also support your larger project on market fragmentation. Thank you very much.
Thank you, Martin. Bill, you're the last speaker. The floor is yours.
Hi, Dietrich. Thank you. This is Bill Nelson. I'm the chief economist at the Bank Policy Institute. The Bank Policy Institute is a research-focused trade group in the United States, representing the larger banks and large foreign banks that have significant U.S. operations. So I applaud the group for all the work and for the report. I think the report includes a lot of extraordinary information. I actually found the glass more half full than the report seemed to be finding things a bit half empty. But in any case, congratulations on the report. I'd like to make 3 points, and I'll try to do so very quickly. So first, I'd like to push back on any sense in which the situation in 2020 in March, the spring, can be characterized as the banks again being bailed out. It was really quite the reverse. Between February 12th, so I'd like to point out that since the last financial crisis, banks have doubled their capital and quadrupled their liquidity. And that was really reflected in the results during the most recent financial events. So between February 12th and April 1st, bank loans increased by $700 billion. For comparison, Federal Reserve loans increased over that period by $130 billion. And this was primarily banks meeting draws on lines of credits from non-financial businesses. And that was, I think, a critical reason why at the very early stages of the crisis, banks, businesses, households were able to keep going. Now, importantly, this occurred without any indication that banks came under liquidity pressures or that there were counterparty concerns about banks. Now, there was an initial uptick in LIBOR, in other bank bond spreads, but there was no lasting widening, and it quickly returned back to normal levels. And as is the case, actually there wasn't a financial crisis following these very severe events in March. Things settled down quite a bit quickly. And I recently re-estimated a model on the probability that one is in a financial crisis that I developed with some economists at the Federal Reserve Board, and decomposed the reasons for the improvement. And it was precisely because there had been no lasting widening in bank credit spreads. Was the reason why the probability that one was in a financial crisis, although it jumped up significantly in March, quickly moved back to normal levels by the end of the month or the middle of the first couple of weeks of April. So that would be one point I'd like to make. The second is that regarding the estimate of the costs and benefits of the crisis, again, excellent work, but I do want to point out that what the economists measured was the benefit from increasing bank capital CET1 ratios from 7% to 7.59%. And 7% is the levels that they were going into the last crisis. Right now, in the US, bank CET1 ratios are 12.24%. And since the benefits of increasing capital are nonlinear, if you measure the benefit from going the last 59 basis points instead of the first 59 basis points of the vast increase in capital that has occurred since the crisis, you get quite different results. And this is important because this is a yardstick that should be guiding decisions about whether further reform is needed or would be appropriate. And actually, if you use the last 59 basis points, you find that the benefits did not exceed costs. In fact, the reverse was true, using precisely the analysis that the FSB team used. So the final point I'd like to make is there were several instances in which the report obscured the results by country. And I think that's very unfortunate, because for individual countries to know what they need to do, the report should be reporting on what the results were for each country. For example, figure 372 on page 130 of the technical report obscured is a very crucial figure. It's the one that shows how much the too big to fail funding premium has changed since the funding, the too big to fail reforms have been implemented by country. But the countries aren't listed, they're obscured, they're just given numbers. So I'd actually be very eager to know what those results were for the United States. I was wondering if there's somebody who could actually answer that question now. Thank you, Dietrich. Thank you, everyone.
Thank you, Bill, and thanks to all who have contributed to what I think has been a very rich discussion that does provide very useful input for the work that is to come. And on that, I would now like to turn to Claudia Buch to perhaps summarize her takeaways from the discussion and let us know what lies ahead. Claudia, please.
Yes, thank you very much, Dietrich. Thanks to all, to the speakers, those who've contributed with their feedback, the participants, and I should say also, all I'm saying is on behalf of the working group and the FSB and the FSB secretariats, all have done great work in finishing this. So it would be very tempting to really comment on all the things that you've raised, but let me just cluster the feedback I've heard in three groups. So some of the feedback is clearly in line with what we find. So we also stress the gaps that are there and the need for more information, for example. So I welcome everybody who hasn't had the chance to look at the report to read it and to take a look. So some feedback also suggests that there's different views on how to interpret the evidence. So we will check whether we need to be more clear, offer alternative interpretations, and maybe also give updates of the analytical work. I'll come to that in a second. So we will take all this on board and consider it. I should also say that some issues raised are not really within the group's mandate, and so we plan to finish the final report early next year, so we also have to restrict ourselves. But we've listened very carefully, the FSB members have listened very carefully, and there are a lot of issues that you've mentioned that will be taken into account in further FSB work, of course, without prejudging the assessment of the committees and the FSB membership. So that holds for non-bank financial intermediation, CCP. So there was a lot of things that people have mentioned. So what are the next steps here? As I said, we will take all the comments that we've heard, all the written feedback, also the written feedback that came through the chat function. It will be considered by the group. You will hear our answers in the final report that will have also a summary of the feedback. And I really encourage everybody who's listening now, and I see we still have a lot of people online right now, to really consider giving us written feedback. Send your comments to the email address that is given here, fsb@fsb.org, by September 20th, September 30th, I'm sorry, 2020. With the subject too big to fail evaluation. The consultation questions are given at the beginning of the report, so you see them, the main questions here. Do we draw the right conclusions from the evidence? Do we identify suitable findings? Do we include all relevant evidence? So send us more if you have more evidence that you're aware of. You don't have to answer all the consultation questions. You can be selective, but we're just very grateful receiving feedback from you. Just a small word on what else the group is doing in addition to going through the feedback. We are planning targeted updates. So most of the analytical work stopped prior to the pandemic, and we will update in particular those studies and those analytical pieces that are based on market prices, because as many of you have said, we expect to see interesting evidence in there. Obviously, the report doesn't say anything on the effects of the corona pandemic and all the many people mentioned the monetary policy measures, but of course there's also been many fiscal measures that try to protect the financial system from the effects of the pandemic. And what we say here in the report is that obviously having more capital in the system being more resilient, having more instruments available also helps policymakers dealing with the effects of the pandemic. But some targeted updates will be done by the group. Yeah, and then, as I said, the plan is to publish the final report early next year. Let me stop here. I think it's right on time. And again, thanks everybody for giving feedback, for listening, and we're very grateful for that. Thank you.
Thank you very much, Claudia. And let me just add 2 points related to the large number of references that have been made to the impact of COVID-19, of the pandemic on the financial system, on the March turmoil in financial markets, and questions around the resilience of non-bank financial intermediation. So the FSB has this year reported twice on the financial stability implications of and policy responses to COVID-19 in April and in July. These 2 reports are available on our website. I would very much encourage you to have a look at them. And then in addition, on NBFI, the FSB has formed a senior group of market regulators and macroprudential authorities to build an overall view of resilience in the non-bank financial intermediation sector. And this group is working intensively right now and will deliver a report to the G20 summit this November in the form of a holistic review of the market turmoil in March. So I think we'll be in touch with quite a few of you in the context of the preparation of this holistic review. With that, thank you very much for everybody who contributed, participated, in particular to our speakers, and have a good afternoon and or good evening. Bye-bye.
Thank you very much.
Thank you. Bye.